Hey everyone, welcome back to Corporate Decoder, the place where we see a company getting a $60 million lifeline that might actually cost them a whole lot more. Stick around to find out how. Today we are looking at a recent filing from Cycurion Incorporated. This filing details a new agreement that gives Cycurion access to a large chunk of cash, but it also comes with some pretty significant strings attached. We're going to break down exactly what this deal entails and what it could mean for the company's future. At the heart of this filing is an equity purchase agreement, which is basically a promise from an investor to buy shares of Cycurion stock when the company needs cash. It's like having a credit line, but instead of borrowing money, Cycurion is selling stock to raise funds. They can sell up to $60 million worth of their stock, but there are catches. This $60 million maximum commitment amount sounds great, but it's not just free money. The company can't just ask for it any time they want. There are terms and conditions that need to be met. These conditions include having a registration statement filed with the SEC, which is a document that allows the company to sell these new shares of stock. Cycurion can ask the investor to purchase shares of stock by sending them what's called a put notice. The company gets to decide how many shares they want the investor to buy each time, but there's a limit to how much they can ask for at once, and the overall time frame they have to do it in. Think of it as a limited time offer on their own stock. This commitment period can end if the investor buys all $60 million worth of stock, or after a year after the registration statement is approved, or if either side decides to end the agreement. Now, for the most important part, what price will the investor pay for the stock? Here's the kicker. The investor will pay only 90% of the lowest trading price of the stock during a set period, called the valuation period. This means Cycurion could be selling its stock at a 10% discount to whatever the market says it's worth. It's like having a perpetual 10% off sale for this one particular buyer. There's also an upfront cost to this deal. Cycurion has to pay the investor for making this commitment. They can either pay $1.8 million in cash, or they can issue a warrant, which is like a coupon that allows the investor to buy shares of stock at a very low price. Either way, it's a significant payment just to get access to this equity line. To make this whole thing work, Cycurion needs to file a registration statement with the SEC by May of next year. The goal is to get this registration approved by July of next year so they can start selling shares to the investor. Let's dive a little deeper into that warrant, that coupon for stock we mentioned earlier. This warrant allows the investor to buy up to 4.5 million shares of Cycurion stock at a price of just 1/10,000th of a dollar per share. That's practically free. There's a limit to how many shares the investor can own, initially 4.99%, but that can be increased later. This is to prevent the investor from gaining too much control of the company. To make sure the investor can actually sell the shares they buy, Cycurion also signed a registration rights agreement. This agreement forces Cycurion to register all the shares the investor might get, including the ones from the warrant and the ones they buy through the equity line. This allows the investor to resell these shares to the public, making them more valuable. All these details are laid out in the actual agreements, which are attached to this filing, so anyone can go and read the fine print themselves. Now let's step back and look at the big picture here. Cycurion is getting access to a significant amount of cash, which could be helpful for growing the business or funding operations. However, they are giving up a lot to get it. Selling shares at a discount and paying a large upfront fee means existing shareholders could see their ownership diluted, meaning their shares become worth less. This type of agreement can be a good option for companies that need cash quickly and don't have other options. But it's also a sign that the company might be struggling to raise money through more traditional means. The fact that the investor gets to buy shares at a discount suggests they see some risk in investing in Cycurion. So what's our take on Cycurion's situation? On one hand, they've secured a lifeline that could help them grow and expand. On the other hand, they've essentially made a deal that could hurt existing shareholders and signals some financial challenges. The discounted share price and upfront fees are significant drawbacks. It really comes down to how well Cycurion can use this cash. If they can turn it into significant growth and profitability, then the dilution and cost might be worth it. But if they can't, then this deal could end up being a burden that weighs down the company's future. Whether this was the right choice, only time will tell. We'll be watching to see how Cycurion uses this new funding and whether it can overcome the challenges that this type of agreement presents. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings.